Hi everyone, thank you for joining us and we hope you're having a good day. My name's Liam and I'm part of the marketing team here at Netwealth, and I'm excited to be joined today by Ofer Karliner from Magellan Asset Management. I know Ofer can't wait to take you through the world of infrastructure investing, but first I will quickly run through some housekeeping items with you. So this webinar is being recorded and a copy will be emailed to you within a week of this webinar concluding. You'll notice that you have a taskbar to the right of your screen, and there's a bit of a chat box. If you have any questions, please type them in there and Ofer will answer as many as he can at the end of his presentation. And finally, if you're on social media and you'd like to talk about today's activities, please use the hashtag NetwealthInvest or tweet at NetwealthInvest. A reminder that, as always, the information provided today is general information only and is not intended to substitute professional financial advice. So as mentioned, I'm very pleased to be joined today by Ofer Karliner. He's the portfolio manager at Magellan Asset Management. So Ofer joined Magellan in 2016 in the infrastructure, transport and industrials team, with responsibility for company analysis and portfolio management functions. And he later became portfolio manager in 2017. Ofer has more than 20 years experience in investment, including more than a decade in infrastructure investment. And today he is going to share some of that knowledge with you. So please take it away, Ofer.
Thank you very much for joining, guys. Today I'm going to talk about infrastructure. I'll start with defining the sector and also talk about why we consider definition to be critical to the returns you achieve in the sector. I'll talk about some of the risks we face and some of the bigger issues, including technological disruption, as well as risk from interest rates, which is very topical at the moment, and I'll also talk about the fund itself. So starting off, what is infrastructure? So most people will tend to agree that to be considered infrastructure, you have to be has to be a company that provides a service that's essential for the functioning of a community. By that I mean you want to switch on the light switch and have the power come on, and the lights come on. You want to turn the tap and see water come out. You want to hop in your car and be able to actually find a road to drive on. We go a step further at Magellan. We're very conservative in the way we think about the world, and we want to make sure that our earnings are reliable and our cash flows are reliable as well. What that means for us is that earnings are not sensitive to competition, commodity price risk or sovereign risk. What we mean by that, so competition, if it's competitive industry, over time your returns will be eroded away. We're trying to avoid that. Commodity price risk adds a lot of volatility to earnings returns. Again, something we don't want as an infrastructure investor. We're looking for stable cash flows through time, and sovereign risk can actually have a material impact on the outcome you achieve, in particular in foreign markets where the government can interfere with the property rights of private investors. So when you think about what infrastructure is in that regard, you go out and you build a very large piece of capital equipment, be it some transmission lines or a toll road or an airport, and you're aligned on enforcing those property rights over the life of your concession agreement. If you can't be sure that you can enforce those property rights, you can't be sure of the cash flows. So for us, that means, for example, we won't invest in China. We've seen multiple examples where the government has interfered with the rights of private individuals, and you can't really take the government to court in China and win. So China is out for us, despite the attractive underlying dynamics of that market. What we're trying to achieve, again, is not get rich quick. It's to generate stable cash flows through time and grow wealth with certainty. If we want a highly defensive portfolio, we want inflation protection and low correlation with other asset classes. So in terms of what we mean by infrastructure, a good example is the power industry. We classify that into 4 different parts. There's the generators who produce the electricity, transmission that takes the power from the power station to the grid, distribution that takes it to your house, and finally the retailer who sells you the power. In terms of generation, it's a highly competitive industry. The power price fluctuates materially. I think last year in Victoria, the power price fluctuated from around $13,000 a megawatt hour to minus $300 a megawatt hour. So you're paying people to take power away from you. It's a perfect commodity. If you don't use it, you lose it. In that situation, cash flows aren't certain. So we don't consider that to be infrastructure or investable from our point of view. In terms of retailing, Australia is the most competitive retailing market in the world. I challenge anyone who hasn't had a late night phone call or an email from someone trying to get them to change power provider. And you do that based on price. You get a call saying we'll offer you a 10% discount or a 15% discount to your current power bills. So you're winning customers based on price. I think the churn rates in Victoria, which is the most competitive market in Australia, are roughly 27%. So you hang on to a customer for less than 4 years. So in that environment, again, cash flows aren't certain. So we don't like that as a business. The bits in between, 100% regulated, transmission distribution, we like that. We get a lot of transparency in terms of the regulation. We get a lot of transparency as to the cash flows that you're going to earn. And in Western markets, the future path of regulation is relatively clear. The formulas for calculating allowed returns are fairly certain. You're insulated from big increases in costs. And as a consequence, cash flows streams are fairly stable. So we prefer that part of the market to invest in. I must say that a lot of the indices and a lot of competitors will include generation and retailing potentially in the universe. So when we look at our universe, we strip all those out. So in terms of the broader universe, there's probably around 350 stocks in the various indices across the world that are used. Again, we strip out power generation and power retailers. So we're left with water utilities, gas utilities, and electric transmission and distribution in the utilities segment. And that utility segment represents about 60% of our investable universe. Transport represents about 40%. That's airports, toll roads, pipelines, communication, ports and rail. So communication, think of cell phone towers. We strip out, it's called master limited partnerships here. Those are pipelines that have a high degree of commodity exposure. So oil prices can actually materially affect the cash flow streams for those businesses. We do own pipelines where we earn revenues by tolling the volume rather than the value of the product in the pipelines. We think those are infrastructure, but we're exposed to commodity prices directly. We strip those out. Social is a very small part of our universe. There's a couple of stocks globally, but it is something we would consider where we're not taking direct exposure to patronage, for example. So PFIs. So I talked about why definition, or our view of definition and why it's important to us. Interestingly, it's vital actually to the returns you achieve over time. So what we have on these two charts is the dark blue line called pure infrastructure. That's anything that meets our definition of infrastructure. So not the fund, but anything that meets our definition of infrastructure is included in that index. The light blue line is UBS 50/50 Common Infrastructure Index, and the green line is the MSCI World. So what we can see in the tech rack is the light blue line, standard infrastructure definition, basically tracked what the MSCI World did, global equities did, over the tech rack period. Now, pure infrastructure wasn't exactly shooting the lights out. It was relatively flat in the initial years, but it did what it's supposed to do. It was defensive. It held and protected value. And in fact, by the time that the standard definition of infrastructure had got back to zero, or back to where it started, the pure definition was up 48%. Again, in the GFC, initially what we saw was the high quality definition, our definition of pure infrastructure, fell in line with both MSCI World and the standard definition. And if you think about why that happened, infrastructure as a sector tends to carry a lot more gearing. GFC started as a credit crisis, so anything with high gearing got hit heavily initially. What we saw is a recovery more quickly and more rapidly than, more robustly than you saw for standard infrastructure. If you think again why that is, banks who are credit rationing in a tough environment are going to lend to the highest quality credits first. The high quality infrastructure companies continue to generate very strong cash flows during this period. So if you're credit rationing, you would lend to these guys first. Therefore, they were able to roll their debt sooner and at cheaper rates than some of the more structurally challenged companies. As a consequence, it took 33 months for them to get back to where they started. And in fact, by the time the standard definition of infrastructure had got back to zero, our definition was at 45%. So again, quality is vital, and we call it the triumph of cash flows. The ability to consistently generate cash flows in difficult economic periods means these companies are highly defensive. So for us, we're going to talk about the investment objectives and what we think infrastructure can and should achieve. Similar to Magellan product, we have an absolute return focus, so we target inflation plus 5% through the economic cycle. We also want to protect capital in adverse markets. And you can see from the previous slides, that's what we in fact achieved. And again, over time, we've delivered to that objective. We've actually had some very good performance over the last few years, well above what we normally consider to be normal in terms of absolute returns. If you look at the since inception numbers, around 8.7%, that's kind of what you expect. So inflation plus 5 or 6% is kind of the guide to what we'd expect. In terms of individual year-on-year performance, one thing that stands out we get questions about in particular is 2016. That's an oil price story. So the index contains a lot of those MLP stocks that have a lot of oil exposure. So if you look on the bottom two rows of this chart here, or this table here, July 2014 to January 2016, the oil price fell 70%. The Alerian MLP index that focus on US pipeline companies, MLP companies that have oil exposure, oil and gas exposure, was down 46%. The S&P index was down 0.6, and we're up 22.5% in that period. Conversely, in February 16 to December 17, the oil price rallied 74%, and the Alerian was up 24.5%. We were up 23.2 versus an index of 30.2. What we've done is achieved what we set out to achieve, which is stable returns through time. We're not going to chase the index. We don't focus on the index. And we want to strip out that volatility and achieve an absolute return with a high degree of certainty. And that's what we're trying to do by stripping out oil price and commodity price risk. What it also achieves is a very low correlation to other asset classes. So one of the reasons you look to invest in infrastructure is to diversify and provide that stability. So you can see the correlation against the MSCI World is 0.4. It's extremely low. We've also seen over the last 5 years, the downside capture has been negative. So that means as the MSCI World has fallen, we've gone up. Now, we wouldn't necessarily expect that to continue going forward. We think the volatility over the next sort of 3 to 5 years will be more driven around interest rate risk, interest rate movements. So we would expect that to be low, but not to be negative going forward. So what about interest rates? It's a topic everyone's talking about at the moment, and particularly for infrastructure, people often equate infrastructure to call it a bond proxy. It's probably a misunderstanding to some degree about the actual underlying businesses. So when we think about interest rates, we look at two impacts: the impacts on cash flows of the business and the impact on valuation. So if you look at the impact on the actual businesses themselves, it's quite limited. So for utilities, by and large, if your costs increase, you're able to pass that through to the end consumer through increased rates. You're allowed a certain return on equity. So if your costs go up, your bills to your consumers go up. As a result, and there may be a lag, but as a result, you're largely protected from interest rate movements. For infrastructure, to the extent that interest rates go up due to increasing inflation, by and large, you can pass that through directly to your customers. So tolls on a toll road go up with inflation on a quarterly basis, for example, or a yearly basis, depending on the road. So that's passed through directly. It then becomes an issue of real interest rates and what real interest rates do, and that's an impact on valuation. So for us, we already expect interest rates to rise, and we built that into our modelling. We think globally, interest rates are being manipulated by central banks. I think they are being manipulated by central banks, particularly in the US, Europe, and the UK. So what we've done is normalise, in our modelling, use normalised long-term rates. So for example, we use 4% nominal, 2% real interest rates in the US. Again, to the extent there's inflation impacts, we're not really worried about those. We can pass those through. If real interest rates go above 2% in the US, and it's about 0.75% now, 0.5 to 0.75%, then we start having direct valuation impacts. But until that point, we are very comfortable. We've already been conservative and built that into our valuations. What we're also seeing is the debt market conditions are incredibly good, and these companies are still managing to roll over debt that's higher priced debt at very low levels. And what they're also doing is extending the term of that debt. So looking back 10 years, the average tenor of debt, the length of debt, was about 3 to 4 years. 5 years ago, it was probably 5 to 6 years. Our current portfolio is 11.3 years, average term of debt. The cost of debt is also coming down materially and will continue to do so for some time. You're rolling over debt, particularly in places like Europe, which is much higher prices. So debt that was done in the European financial crisis, for example, was done at much higher levels. And we can see here, there's a number of examples where companies have raised debt at very low levels. Zurich Airport, for example, had 12-year debt at 0.62%, which is incredible. An Italian company, Italgas, $500 million debt at 1.625%. This is Italy. Airport de Paris, 10-year debt at 1.1%, 15-year debt at 1.5%. It's incredibly low rates. So these are being locked in for very long periods at very low levels. So the cash flows of the underlying businesses are actually quite insulated from this in the short to medium term as well. That doesn't mean the stocks won't react. So what we have on this slide is 3 examples where we've seen spikes in treasury yields. On the left is a taper tantrum. Ben Bernanke talked about tapering, and treasury yields jumped about 90 bips. Trump election in 2016, and the US tax reform more recently. In all those cases, the 10-year treasury yield jumped and the fund underperformed. Well, what you can see is that, so in the first 2 instances on this chart, which are highlighted in orange, it wasn't just a return to growth, it was a return to trend. And it was done in short order. Again, I mentioned before the triumph of cash flows. People see these things as bond proxies and they trade as bond proxies on occasion. That provides opportunities for guys like us who are specialists who can look through that noise, understand the underlying assets and understand the underlying cash flows to take advantage of that. As a consequence, we have held relatively high cash positions, sort of 8, 9, 10%, and we've deployed that every time we've seen this sort of volatility in the markets through time. So one of the key features of infrastructure is reliable earnings. So in terms of utilities, again, we talk about regulation, and I've talked about regulation and the certainty that regulation gives you in terms of your cash flow generation. So generally speaking, you're allowed to earn a fair return on capital. That means you're insulated from changes in demand, changes in inflation, changes in interest rates, changes in wages, etc. You can pass that through to your end customers. It then becomes an issue of understanding the regulation and the way the regulation can change through time. In most Western markets, that regulation is fairly transparent. That makes valuations for these businesses relatively simple. You should be able to see and understand the cash flows from this business going through time. So this is a chart showing what's happening in the US. This is all the US utilities, electric and gas utilities, and their allowed returns on equity. You can see there's some outliers at the right where the government's trying to incentivize some particular investments. And on the left, it's sort of some older utilities with not a lot of investment out there, particularly in democratic states, where the returns are a bit lower. But on average, that's 10.5% return on equity allowed. That's great. You want to know also what happens through time. And what we've seen, that's been quite stable through time. In fact, one of the interesting things to see in 2009, the return on equity was 10%. You think about that in the context of an environment where most companies were struggling to return anything on equity in those years, in fact, getting negative returns on equity. Another really interesting point is return on equity actually went up from there. So even as interest rates were falling, the allowed returns on equity went up. That's because regulators were looking to incentivize these guys to invest more money in their local markets. They wanted them to invest to help generate jobs and create economic activity. So we saw ROEs go up during this period as well. So the question then becomes, what about technology impacts? What gives us confidence that we're not going to be impacted by technology disruption? So for us, what we hear about a lot, what we talk about a lot is renewables. So one of the things people talk about is the subsidies, and the subsidies for solar and for wind in particular, and the impact that's having on distorting electrical markets. Again, we don't invest in generation, but ultimately it's part of the reason why. But we do own some of these assets through regulated utilities which have generation in there as well, so it's regulated generation. Interestingly, what you can see from this chart, this is from the International Energy Association, is that by 2021, so 2022, wind will actually wash its face, will actually stand up without subsidies and be the cheapest form of new power coming into the market. So without subsidies, zero cost marginal production wind will actually displace significant amounts of combined cycle gas and certainly coal. So it means if you're a power producer, this is actually quite a big risk to your underlying business. Again, we will only invest in generation where it's regulated. The next impact is distributed power, rooftop solar effectively. And what we've seen is rooftop solar costs have come down. This is for Australia. They've come down across the world. That's a scale issue as much as it is a technology development issue. So there's been huge ramp ups in production of these things which have brought down the costs. So the question then becomes, when you add batteries to that, does that mean the end of the grid? Can people disconnect from the grid? And that, in theory, that could create a problem. If you have a grid that relies on scale, if people start disconnecting, the cost goes up for the remaining users and encourages more people to leave. We don't think that's actually going to happen. The main reasons, the main reasons for that is it's extremely expensive to create standalone reliability. Being connected provides huge redundancy, and again, not all houses can self-generate. So you need a north-facing roof, and you need a north-facing roof of sufficient size to actually have enough solar panels on there. You want redundancy in the system. If the sun doesn't shine for a number of days, what are you going to do in terms of power? And interestingly, someone talked about the Tesla Powerwall. The Tesla Powerwall, the current peak capacity is about 7 kilowatts. So that can run a kettle and a toaster at the same time. So if you want to actually run a household properly, you need multiple ones of these, and effectively it isn't something we think is a real risk to the business model. Again, the costs are prohibitive. This is a Grattan Institute study in 2015. So to get peak off-grid reliability of 99% is $52,000. 99.9 is $72,000 versus a 10-year cost of grid connection of $12,900. So the costs are much, much higher. That also means even at 99.9%, that means 3.5 days a year without power. So you have to understand that 3.5 days a year, your system isn't going to be working. You also have to build a system that meets your peak demand. So if you have people around for dinner, the air conditioning on, the oven going, the lights are on, the TV's on, you have to build a system that will actually be able to support all those things at once when the sun's not shining. And again, the cost of that is prohibitive for most people. Even with all that, if you can get through all those issues, power consumption is on the rise, not on the fall in the long term. And part of that's an electric car story. So currently they're a very, very small part of the global fleet. I think last year, 1% of car sales in the US were electric. Places like Norway, it's a lot higher, but Australia is also a very, very small part of the average new car sales. But when it picks up, and we think it will increase in adoption, that means a material increase in power requirements for households. The average Tesla Model S will increase power usage for the average household by around 60%. So again, you're not building a system for now, you're going to have to build a system that's 60% larger. Again, do you have the roof space, do you have the battery capacity and the space to store all that kind of equipment? And most people don't. That's why we're confident that it's not the end of the grid despite what people talk about. Transport's a bit different. So transport infrastructure is generally regulated at the point of price, not of earnings. So for toll roads, for example, it's the number of cars times the average toll is how you generate your revenue. The average toll is restricted, but you can earn as much money as you want depending on how many cars go through that toll road. So what you have to be comfortable with is that you're taking on patronage risk. So we do a lot of work trying to understand the risks around patronage and what's driving traffic. So this is CityLink in Melbourne. And what we can see is that while traffic's been relatively stable 2.5% growth over the last decade. Revenue's grown by 8.1% through a combination of mixed change, more trucks, and toll increases. And operating leverage means you're actually getting a 9.3% compound annual growth rate. So you basically got 130, 140% growth over 10 years in earnings from a very, very low risk asset. That's what we love about these kinds of assets. In addition, cars dominate large city transport. This is Sydney, so 80% of trips travelled, and this is slightly old data, the new report should be coming out this year, but we've seen it consistently across the world, where cars are roughly around 80% of transport to work. What that means is people are reliant on their cars, they have to use them. Simply, the public transport systems focus on the CBD. If you want to get to or from the CBD, they're great. If you want to get between places, you want to go to Bunnings on the weekend or take your kids to school, public transport simply won't do it. Won't be able to meet that demand for those trips. People rely on their cars. And part of that is the wealth effect as well. So what we've seen through time is that the wealthier a country is, the greater the car penetration. So in the US is at the top there with 8 cars for every 10 people effectively. That's men, women and children. So effectively every person in the US owns a car. Australia's not far behind. But what we're seeing down the bottom is growth in places like China, Brazil, etc. And as their growth increases, we'd expect them to move up that curve. And what we've seen here as well is wealth effects. This is showing the Sydney Harbour Bridge and Tunnel from 1950 to today. And what we can see is consistent growth in patronage. So very strong and stable growth in patronage through time. Partly a wealth effect, people have earned more money, wealth has increased per capita, and the cost of cars has come down as well, and they're enabling people to buy more cars. One thing that stands out here though is sort of a flat spot in sort of the 80s and the jump in the early 90s. Probably wondering what that is. That is the Sydney Harbour Bridge reaching capacity in the 80s. Bear in mind it was built in 1932. So it's great foresight to only hit capacity in the mid-80s. And what we're seeing is the Sydney Harbour Tunnel opening, and that basically alleviated the congestion on the Sydney Harbour Bridge. You should also note to jump back to trend, didn't just start growing again, jump back to trend. So there's latent demand built up in the system. What we're seeing now is that's flat spotted again. Top of that chart from sort of 2000 on hasn't grown much, and now the government's talking about a third harbour crossing. So that provides opportunities for guys like Transurban, etc., to develop those assets. One of the things we also like about toll roads is what we call the corridor effect. So generally, no one likes toll roads. They're built because the existing roads are full. This is an example of the M5 toll road in Sydney. When it was built, Canterbury Road and the Hume Highway were full. The corridor growth has been a little bit above population, about 2.7%. What we're seeing is the M5 has captured all of that growth. So M5 has grown at 7.7% since it opened in 1992, sorry. That means these corridors and these toll roads can grow well above population for very long periods of time because they're capturing all the growth in the corridor. And that's all well and good, but you ask about what about price? At what point do people become price sensitive so we won't use the toll road anymore? This is Sydney's Eastern Distributor. What we can see is that between 2000 when it opened, is 2016, tolls are up 123%. Yet traffic more than doubled. There's not many consumer products out there where you can more than double the price and more than double demand. Simply no alternatives. People have no alternatives to use. They're be forced to use this road. It's not great necessarily if you're a driver, but if you're an owner of the asset, it's fantastic. So technology impacts is something we think about a lot. In particular, driverless cars is something people talk about a lot, and we have to think about what impact that will have on traffic demand over time. So the case of driverless cars is very strong. So 1.2 million road deaths annually. People use cars only a fraction of the time. So on average, between 4 and 5%, depending on the market. They sit in your garage at home, let's sit in your garage near work, and people don't drive them. And it's a very large capital expenditure. When people talk about driverless cars, you sort of see they talk about various levels. Level 3 exists at the moment. So effectively, the Audi has a car, level 3 car, where you can turn around. Tesla's autopilot is level 3 as well. In theory, you don't have to pay attention, but you should. Effectively, there are times you should be intervening. Level 4 is actually on the road now as well. Google has a level 4 car testing in Phoenix. The Tesla car that hit, the Uber car, driverless car that hit someone in Phoenix was actually level 4 as well. In theory, this shouldn't require a driver to be there. It still has a steering wheel. This is full automation. So the car drives itself. You tell you where you want to go. You can sit in the back and not worry about it anymore. Level 5 is simply no steering wheel, no pedals. So if you hear people talk about those numbers, those levels, that's what it means. You've seen, I think we call it now, we're at peak driverless car. People are extremely excited about it. We've seen huge numbers, or huge variation in the numbers in terms of expectations of take-up. This is one chart we've seen quoted several times. This is saying by 2025, so 7 years from now, we'll have close to 25-30% of cars on the road having level 3 or level 4 automation. We think that's extremely aggressive. The average turnover in Australia of the fleet is about 4 to 5%, similar numbers in the US as well. So it still will take quite a long time to get high levels of penetration. We do think it's coming though. So we have to think of what impact that will have on toll roads. Toll roads are, by definition, highway grade roads. So no traffic lights. They tend to be very well signalised, so well marked, etc., and well maintained roads. Highway grade roads will benefit disproportionately to other roads, whether they're toll roads or not, for a number of reasons. Firstly, we expect initially the driverless cars will be limited to these roads, partly because of the impact of there's no pedestrian interaction. The risks are a lot lower if you're in an environment with simply only cars, no pedestrians, no traffic lights, etc. Secondly, research shows that it would actually double the capacity of highway grade roads, where signalised arterial roads or suburban roads will only increase capacity 5 to 15%, because the cars have to be more cautious around an urban environment, where on a highway they can travel faster, closer together. That means that you can increase the throughput materially. So highway grade roads, toll roads are going to benefit disproportionately. Again, we're also expecting autonomous vehicles to actually increase the total kilometres travelled. That sounds counterintuitive in some respects. People talk about transport as a service. We think that will form an important part of dense urban centres. However, as you move out from the urban centre, the costs become very, very high. It's also not economically rational for most people to own a car now, but they do because it's convenient. You have a child seat in the back of your car, you have its surfboard rack on the top, you store stuff in your car, it's there whenever you want it. There's huge benefits to that as well. So people will still own cars. Well, the study is showing 3 to 10%, despite car sharing, of traffic growth. Talking about empty car trips, you go to work, you get out of your car drives itself home, that's an extra trip. It comes back to pick you up later, that's an extra trip that wasn't being done before. You have induced demand, so people who can't drive now, whether it be children, old people, infirmed, etc., all of a sudden can drive. They simply call the car up and tell it where to go. Most importantly though, it actually reduces the value of the time wasted in the car. Right now you get into your car, you sit down, you grab the steering wheel, you look out the window, and you maybe listen to the radio, could possibly talk on your phone. You don't have many options of what to do. As soon as you're no longer driving, it frees your time to do whatever you want. You can set up your car to have a TV screen, have a bed, have an office in there as well. What that means is that as the travel times decrease and the cost of being stuck in a car decrease as well, people will move further and further out from the centre of cities. That means more highway travel as well. So you're actually going to generate more trips, and longer trips that weren't being generated before as well. So we think, again, technically it's going to be a long-term positive for toll roads, particularly where there are no alternatives in terms of free highway grade roads. So in terms of the fund itself, at the moment we are in a sector level. We'd ordinarily expect to be sort of 50-50 utilities infrastructure. We are closer to 60% infrastructure and at 30% utilities at the moment. A lot of that is to do with valuation. So we think utilities, particularly US utilities, are quite expensive. As a result, we've underweighted US utilities in particular. And you can see that on the right, where USA is probably 50% of our universe, and it's about 25-26% of our total holdings, and a lot of that is in things that are they're not utilities. So that's telco towers and rail in particular. I talked before about the ability to use cash as well. In 2014, as a house, Magellan took the view interest rates were more likely to increase than fall, which wasn't extremely brave given they were at zero. But we took a view we need to increase the cash weight, because as interest rates rose and as the expectation of interest rates rising came through the market, we'd see increased volatility in the market. It's taken longer to play out than we expected, but it has started to occur now. What we've seen though is every time that's happened, the volatility has created opportunities for us to invest. So leading into the start of November in 2016, we were close to 10% cash. By the end of the year here, you can see we're at 6, and we've got down to about 5.5, deploying cash in the opportunities that were created by the volatility from interest rate expectations changing. So we've been quite tactical in the way we've used it. Over the long term, as interest rates normalise, we expect to be sort of transactional cash levels, 2 to 3%, but we are using it tactically at the moment. And again, through time, you can see we've basically achieved what we've set out to achieve. So CPI plus 5% is the target for the fund, and since inception returns of 8.2%, is slightly better than CPI plus 5 during the period. Ultimately, we've generated good returns and actually protected capital in adverse markets through what we set out to achieve.
Thanks, Ofer. Great presentation. Hopefully the listeners enjoyed that. Maybe they'll see toll roads a lot differently now. For those of you listening, the funds Ofer was speaking about, the Magellan Infrastructure Fund, is available on the Netwealth platform. Just go to our Compare Funds and Models page to find out some more information. And as a reminder, just if you have any questions for Ofer, please just enter them into the question box on your right there, and we'll answer them shortly. I found the discussion around driverless cars really interesting. Joint managing director here at Netwealth, Matt Heiner, he's adamant they're coming, and he keeps bringing up the idea that his 2-year-old son may never need a driver's license, which is quite a scary thought.
I absolutely think they're coming. We completely agree. There's so much money being poured into the sector at the moment. Looking across Silicon Valley and as well as China as well, is investing heavily in the sector and the space. These things are definitely coming. It's the timeline that matters. It's not simply a matter of the technology there. You also need laws to catch up in terms of enabling these things to travel on the roads. The insurance industry has to think about how best to deal with the problem. It becomes a product liability issue rather than a driver issue. And also things like ethics become a big issue. So we call it a trolley problem. So if you're driving down, or driverless cars driving down the road, and all of a sudden a child runs into the road, the only way to avoid hitting the child is to swerve into a tree and kill the driver or kill the passenger in the car. What does it do? And if you're driving the car, you make that decision. The question becomes, would you be happy getting into a car that will kill you or could potentially kill you? And that sounds a bit trite, but ultimately this should reduce the number of accidents materially, because I think 90% of accidents, 95% of accidents are due to human error. But would you be happy getting in a car that's programmed to kill you in certain circumstances? It doesn't matter if it's a small child or a dog or an old lady. Do these things matter? It doesn't matter if it's one person in the car or 2 people in the car or 3 people in the car. There are a whole bunch of ethical issues that have to be overcome as well. And can you change the settings in the car as well? So there's a number of issues that need to be overcome to get there. Even some simple things like lane markings, at least in the early stages, and GPS needs to be. GPS works well. It has a margin of error right now, so you can't pinpoint it to a centimetre. So you need lane markings, you need clear signalisation, particularly in urban areas. So if a tree is half blocking a stop sign, does the car know there's a stop sign there, for example?
Yeah.
So there are a whole bunch of issues to get through as well. Most of the testing has actually been done on highways, not necessarily on urban roads. The stuff being done in the US at the moment in Phoenix is actually the first real stage of that urban development, but we have seen already a death occurring there. So
sure, no, some interesting times lie ahead for driverless cars. Another part of infrastructure which you briefly touched on was communication. Sure. Is there any sort of further insights you can give on that and where you think that might be heading?
So communications, we own a reasonable chunk of communication in the portfolio through companies called American Tower and Crown Castle. These are listed in the US. Communications infrastructure is effectively building a tower and leasing out the space to telecom providers to provide mobile phone coverage in its simplest form. So if you think about what that means, these businesses have vertical real estate. You put up a large tower, you go, okay, we have provided all the equipment for you guys to use, and then those guys rent out the space. They have a dish on there, so you might have return on capital for that first dish, and every subsequent dish you actually start making material amounts of money because the costs don't go up materially in terms of additional pieces of infrastructure. And what we're seeing is not just one dish for each user. So let's say AT&T has one dish, but AT&T might have a 3G dish still up right now and a 4G dish right now. They're 10-year contracts. So to the extent 5G comes along, they could, in theory, have 3 bits of equipment on the same tower, plus additional tenants on that tower as well. So these are great assets. But what's really driving the growth is not necessarily the technology from 3G to 4G to 5G. It's the thirst for data usage. So over the 5 years to 2016, data usage increased 19 times in the US, according to Cisco Systems. It's an incredible thirst for data, and it's actually forecast to increase another 7 times over the next 5 years. What that means is you need to densify the network, you need more towers, more bits of equipment to actually be able to cope, so you don't have dead spots in the system. And so they're building towers at a rapid rate and putting up new bits of equipment at a rapid rate to help soak up that thirst for data. And it's only getting greater and greater. And new things like driverless cars, in theory, could require some of that bandwidth as well to actually suck in more data. If you want to watch TV in your car, it's going to pull it off the 5G network so you can watch your TV show, for example.
Yeah, sure.
So these are all interlinked, but they're great assets. And they have generally 10-year contracts with fixed escalators in them as well.
Good. Magellan reports, we've got a question here from Robert asking, as Magellan always reports in Australian dollars, do you hedge your currency risk?
So we have a couple of funds. The main fund, the MIF fund, hedges currency risk. We also have an unhedged fund as well. But we report an AUD, but because that's ultimately what the clients receive. But we do have 2 versions of the fund.
Good.
In terms of...
And is the Magellan Infrastructure Fund available as an ETF?
Yeah, we do have an ETF. So MICH is the code. So you can access that, and that's the hedged version of the fund.
Okay, great. Hope that helps you out, Jennifer.
There's a question on interest rates, downward pressure on asset prices. Yeah. So there's a question here on do rising interest rates impact valuations of infrastructure assets? I think rising interest rates will impact the valuations of all assets and not just infrastructure. I said we already factor rising interest rates into our valuations. So again, we're using a normalised interest rate in all our valuations, and we still see value upside in a lot of the companies we invest in. So yes, absolutely, rising interest rates will impact asset prices, but we've already factored that into our base case.
All right, excellent. I think we've answered most of the questions here, so maybe we'll give it a wrap up. Thanks again, Ofer.
No worries.
For tuning in today. Fantastic presentation. Hope the listeners loved it, and we hope you guys will join us for our next webinar, which will be next month and will be on ethical investing. So hope to see you there. Thank you.
Thank you.